Is the market frozen? Yes. But to Mark's point, I feel like there's momentum with groups that potentially want to sell. I think BOVs, the brokers I've spoken to in the last couple of weeks, you're seeing an increase in volume of BOVs.
Now, when you ask them the second question of, well, what about a risk-adjusted return basis, and you're facing this big vacancy on a potential move out of a tenant compared to the constant turnover of leases and apartments, the risk-adjusted returns are much better in multifamily.
Phoenix is obviously part of the Sun Belt, and I think when you look at if you take the onshoring, remanufacturing of the U.S., Phoenix is positioned really well. I think long-term it's set up for a lot of success, right? Potential economic success. The problem is trying to get people to believe in it today.
For me as a buyer, if I'm gonna lean into a deal and it's in the submarkets that we've talked about, I just have to be so far below replacement costs, and I have to have such a good entry point because I know that's what's gonna get me through the next 18 months.
I have a feeling this episode might spark a little bit of competition, and I'll provide some context a little bit later as to why. But John and I privilege Mark Mandala, Director of Acquisitions over at Brixton Capital. Thank you so much for being here with us.
Yes, sir. Thanks for having me.
You flew in today just for this, right? This
just
is how important this was?
A couple tours, but this was the main reason.
We were hoping you were going to leave that to the side and just say, yes, it was just for the podcast. So Brixton Capital out of California.
That's right.
You want to give us just a quick little rundown,
Sure.
Bio?
Yeah, so Brixton, we are based in San Diego and Solana Beach. We are a family office on behalf of the Brutton family. We have 5 offices throughout Western Europe. Brixton focuses on 2 food groups, multifamily and retail. We own about 5,000 units. We're focused Texas up to Colorado and west. We're really targeting suburban core product, 2 and 3 bedroom units, high retention, pricing power. We're active in Phoenix, Denver last year, and now we're really focused on Southern California and Seattle. We're vertically integrated on both retail and multifamily. There's about 50 employees at Brixton. I lead our apartment acquisitions team. I come from both a debt background and an acquisitions background. I split it really 6 years and 6 years of both debt placement at Freddie Mac, still secured, and acquisitions at Brixton.
That's great. That's great. And when I referenced a little bit of competition, it's a little bit of a family affair as far as the multifamily industry.
That's right.
Your father. Do you want to share? Or do you want me, John, and I to just dive right in?
No, happy to. I grew up with a real estate family, sort of. My dad was the first one to really go into commercial real estate. He's a debt broker over at CB in Phoenix. He's been doing it for about 30 years. So grew up with that and had the mentality from him to just go. So it was super cool to grow up with that. And I moved over to the acquisition side early in my career, and so it's cool to have some overlap between the two of us.
And the reason why I was saying spark some competition is we had the privilege of hosting your dad on an episode previously, so we're going to see which episode draws the most attention.
Hopefully, this one.
I have a feeling
The first father-son.
this is exciting. This is exciting. Yeah, John actually said prior to getting on camera. What did you share?
I don't remember.
That you and Rocco both agreed that Mark is the smarter out of the 3 of you. The smartest.
All of us, yes.
Yes, all of us.
Yes.
I was trying not to throw myself in there, but it was just a
I'm
given.
including you.
Yes, thank you. Mark, thanks again. And
Sure.
we're here, of course. We're going to talk navigating investment and growth in Phoenix.
That'd be great.
We have the privilege of managing one of your deals here in town, and of course, we want to get a little bit more insight. You've led acquisitions at Brixton Capital for a while, of course. What's your current outlook and landscape of capital markets here in going into mid 2025?
Yeah, sure. I mean, look, it's been a challenge, I think, for everybody. Transaction volume, I think, is slowly increasing, but it's been down, and that's not new news to anybody. I think it's helpful to talk about the product that we want to buy, which is suburban core, mostly 2 and 3 bedroom apartments that just has real pricing power on the rents. And we're looking for those assets in preferred submarkets, like in Phoenix, for example, the Chandler, Gilbert, Scottsdale. I don't think there's many just opportunities to buy that product right now. And those that are trading, cap rates are just unchanged at the moment from a 4 3/4. So, your question about the capital markets landscape, I think you're seeing some investors still have long-term conviction in multifamily and in Phoenix. There's lots of tailwinds, but other than those submarkets that just have high income demographics, good schools, maybe dual income earners contributing to the rent and low concessions, insulated from new supply, discount to home ownership, that whole story is attracting institutional LPs.
Sure.
But when you leave that submarket and leave that product type, there's a massive drop off in the buyer pool. And the cap rates will go from, 4 3/4 to a 5 to, I think most people want to underwrite a 5.5 plus, but deals aren't selling there. And that's obviously where the cost of debt is. So that's the big rub right now in the capital markets.
You already, just in your answer now, you already provided a little bit of additional insight to my second question, considering the environment currently right now, specific here to Phoenix. Are there any additional concerns for institutional investors besides just going to the suburban? Yeah. Go ahead, please.
Yeah, totally. I guess you could categorize it in verticals, right? The in-place cap rate relative to the cost of debt. Mm-hmm. And then on the operational side, which John, you can speak to all day about, but they're just, for an LP to take a common equity position, they have to have a lot of confidence in the rents. And throughout most of Phoenix, with the exception of the submarkets that I just mentioned, they're a lot more conservative. They're scrutinizing the rents. Fortunately, we're a well-capitalized family office. And so we've been able to we bought $250 million over the last 15 months, 2 assets in Denver, 1 here in Phoenix. But when you take a step back out of Phoenix and compare it to other markets, you'll see a large bifurcation in pricing power on rents. Sure. And so we're seeing more pricing power along the coast from San Diego, Orange County, LA, Bay Area, Seattle, just as a function of the supply, and less supply there as opposed to Phoenix, Dallas, Denver, Salt Lake. And so we've admittedly spent most of our time this year in Southern California and Northern California.
Okay. John, for you, and hey, welcome to the party.
Oh, thanks.
Yeah.
I was learning, man.
Yeah, it was good to see you. Good to see you. So from our lens, management consultant lens, are we sharing anything different to our clients?
Well, I think if you just look at the market conditions today, if you go back to exactly May of 2022 and look at that entire year, like kind of, snapshot 3 years ago, we had peak transaction volume, 259 transactions that year, most on record. Through April, we had 14 transactions this year. So is the market frozen? Yes. But to Mark's point, I feel like there's momentum with groups that potentially want to sell. I think BOVs, the brokers I've spoken to in the last couple of weeks, you're seeing an increase in volume of BOVs. Now, are the potential sellers happy with where those BOVs are? No. So I think that's the frustration. And then you look at the potential groups looking to buy today. As Mark mentioned, if the cap rate's at 4.75, cost of debt's 5.5, whatever it is, you're going in with negative leverage. So the big difference, I think, today versus 2022 is exactly what he said. You have to have confidence in rents. Well, in 2022, coming off the best operational year on record in 2021, people were underwriting some very favorable rent growth in their 10-year models. And I think that's the struggle today, because you're having a market that is slowly deteriorating because of the supply pressure. We've had 23 straight months of negative absorption. All I mean by that is if you deliver 2,000 units a month, we're absorbing 1,500. So you're building up that excess inventory, and that's going to carry over into 26. So how do you get a group comfortable knowing you're still tipping down, your nose is tipping down in terms of trajectory, to get them comfortable at buying at those levels and taking on negative leverage? So I think it's slightly thawing, but there's more pain ahead, which could result in just, we might have a little tip up, but I think the frozen piece is going to kind of bounce back and forth between dethaw and frozen for the next 6 to 12 months.
You mentioned there's 14 trades going through April. We just the team and I were just updating. We're now up to 17 through in May.
All right,
big numbers, and of course excess inventory too. Not many look at that or pay attention to that at all, do they?
I think you can get, I'll say, manipulated in terms of the narrative, because you think about real estate and really any sector. Optimism is a piece of what keeps the momentum going.
Right.
And I think when you look at net absorption numbers that are published, and yes, it's correct, but it avoids the conversation around the excess inventory. So yes, net absorption might look strong from a market to market perspective or top 30 metros, but what excess inventory is sitting there vacant? And today we're at 11,000 ish. We believe we'll peak at 15,000 in Q1 of next year. And that's with our historical absorption data, our T6 and T12 trend. So you're going to see potentially some increases there. Maybe you have less excess inventory if that absorption number ticks up, but got to have job growth, got to have demand. And what I know for sure is we're going to have a lot of excess inventory next year, over a year's supply just sitting there vacant.
Yeah. Mark, you mentioned most of your time and focus has been California, Northern California. You're here for a reason. Arizona, Phoenix MSA specific.
Mm-hmm.
What is your take on current supply that is available right now?
Yeah. So actually, one thing I also wanted to mention too is what we're competing against just as a multifamily buyer is other real estate property types, which I think is important because we also have a big retail platform. And, I keep talking about suburban core because that's what we want to buy. Well, you could go buy a grocery anchored shopping center at a 6 cap, produce the same return profile that you could get for buying a suburban core multifamily asset. But the in-place cap rate on a retail deal that's grocery anchored, same sort of, everybody wants it type of deal. Your entry point is positive leverage, which is something John and I are talking about. And you can exit at a 6 cap or 6.25 cap and still manufacture those returns.
Right.
And when you talk to investors, they say it's because of positive leverage. Now, when you ask them the second question of, well, what about a risk-adjusted return basis, and you're facing this big vacancy on a potential move out of a tenant compared to the constant turnover of leases and apartments, the risk-adjusted returns are much better in multifamily. So pause there. You had asked about Phoenix.
Is there anything that stands out?
In Phoenix?
In Phoenix, for you, yeah.
Totally. I've lived in either San Diego, Orange County for the last 12 years.
Right.
And I think along the coast, you'll see a more sticky renter base, more sticky population. But then once you start to go inland into the Inland Empire or the likes of that, you'll see this massive out-migration of residents that are moving to Phoenix. And I think what a lot of people forget about is California income tax plus the federal income tax. You move to Phoenix and get a flat 2.5%. The cost of living is just so much cheaper, as is the homes. My wife and I joke all the time, if we had just sold our house and moved to Phoenix now, we could get probably 2 acres of property. So I think the cost of living, I grew up here, so if you can get over the heat, then it's a very nice place to live.
I have to joke because we talk about it. Phoenicians, we live here, of course, and we don't think it's affordable any longer, right? We're the ones that are complaining, wow, home prices have just skyrocketed. There's no way to get a first-time home buyer. It's almost unattainable at this point. So again, it's good to see a different perspective.
Yeah, absolutely.
Right? It's good to see a different perspective. Yeah.
Recently, too, we've had a lot of investors acquire about the water source shortage in Phoenix. Don't need to spend a ton of time on that. I can tell by the look on your face. It's been talked about too much.
Yes.
I don't believe there's an issue there, and I want people to know that.
Yes.
Especially in the places that we're buying in Maricopa County.
Please check out Greg Vogel's podcast.
Oh, it's fantastic.
With us. It was just a month ago, 6 weeks ago.
Yeah. I think so.
He does a tremendous job of breaking down the fact that Arizona has plenty of water, and the narrative from the governor's office, et cetera, is misleading at best. And I think, getting down to facts and understanding that, from a growth perspective, we're in a really good position. We use less water today than we did in the early 70s. So check it out, Greg Vogel's shorts on YouTube.
It's fantastic. It's really good. John, let's go down the same the same path that I was just asking Mark. So from your perspective, what are you seeing as far as investor sentiment, us compared to other major metros?
Well, I think Phoenix is obviously part of the Sun Belt, and I think when you look at if you take the onshoring remanufacturing of the U.S., Phoenix is positioned really well. So that's just luck, right? We're close to Mexico, which has a labor force 10 to 15 years younger than America. It has a tremendous value in terms of our connectivity, our location, and then you tie in the fact that we're so close to California, right? You think about the large carriers, tankers, everyone bringing goods to the U.S., Long Beach, et cetera. They're unloading those cargo ships, delivering it to Phoenix, putting it in the West Valley into industrial, and then taking it out of industrial space,
bringing it back,
reshipping it, and pushing it across the country. So, we're well equipped to handle that today, especially with the 303 growth and our industrial explosion. And you factor in TSMC and all of the investment there, another $100 billion, all of these big announcements, and then the jobs that support these large manufacturing hubs. Long term, all of the the 150 suppliers behind them. I think long term, it's set up for a lot of success, right? Potential economic success. The problem is trying to get people to believe in it today, because you're seeing a weaker job growth number in 2025 than what we expected even. But positively, you're seeing still strong demand. All I mean by demand is you're seeing a lot of strong search and inflow migration into Phoenix still. So I think it depends on your investment objectives. If you're trying to time the market, I'd stay away from Phoenix, right? But if you believe in this fundamentally long term, you underwrite appropriately, you're not over your skis, you're well capitalized, I think Phoenix will be a good market for a lot of buyers.
We're going to hold you to that, by the way.
Good.
Okay, good.
Including
Mark.
This
Yes.
guy.
Yes. Mark, we did touch on this a little bit as far as we didn't go into submarkets. You mentioned difference between suburban to infill, right? Mm-hmm. Do you have? Let's talk asset class, and we can make the comparison East Valley to West Valley. West Valley really receiving a good chunk of all the supply that's coming into our market, but. Do you see a certain asset class being that much more attractive to investors than others, meaning A, B, or C?
New for sure. Yeah, and I went down this deep rabbit hole recently where I just pulled all the sales comps in Phoenix over the last 15 years. And what was interesting is nearly every year, majority of the product that sold, just in terms of total number of transactions, most of the transactions each year that sold were built in 1989 and older. And the last 3 years, they've just been new. They've skewed new.
Yeah.
So, I do think that this multi-reset, if you want to call it that, started in June of 22. So we're now in our third year of that. And you can buy this merchant-built product below replacement cost. And for me as a buyer, if I'm going to lean into a deal, and it's in the submarkets that we've talked about, I just have to be so far below replacement costs, and I have to have such a good entry point because I know that's what's going to get me through the next 18 months. Mm-hmm. And I'm underwriting realistic rents with an economic occupancy that could allow me to absorb the next 2 years. You have to remember we're a family office, so we like cash on cash return. We distribute to our investors quarterly.
It's a good business model.
And so I don't want to see rents drop. And so I think, I'm just highly selective in my deals, and our investors are even more selective. I was talking to a developer buddy, for example, and this is just to compare acquisitions of existing product to developments. And I said, how are your investors evaluating your underwriting? And he said, well, for one thing, we have to build to a 6.5 to 6 3/4 today. And our investors are underwriting concessions in the market today, despite our project delivering 3 years from now.
Right.
Which I thought was interesting because to hit a 6.5 plus, depending if it's garden, wrap, podium, I mean, your rents have got to be $2 to $3.50 a foot, depending on the product. So it's hard to do. But I think the basis becomes really important for a lot of people here to transact right now.
I think the other piece is, if you look back pre-23, if you had if you lined up 100 groups trying to buy and looked at their acquisition models, smart guys like yourself, year one stabilized, coming out of lease up, basically all of that concession was burned off, right? You had a 0 in your model. You're a smart guy. You probably put some concessions, at least in even year 2 in your model. I don't know if you do. And
particularly on the renewals.
Yes. So when you look at, groups today or have conversations and they're seeing 8 to 12 weeks free in the market, they're like, how the hell do I put that into my model and underwrite a 0 for a concession? You can't. And that's when you see people squirm. They start to do the ums and ahs on the phone. And I think that's the challenge today. How long is the runway for those massive concessions? And yes, we're still doing them up front. So I don't want to compare it in a draconian manner like 2008, 9, 10, 11, 12, 13, when you had concessions at 3-4 months free and you were just stair-stepping them down and you were prorating them.
Totally.
Right? So imagine your model then. You're like,
them out.
Hey, good news, owner. We went from 3 months free last year to 2.5 months free, and we think in 2 years we'll be down to 1 month free. I mean, that was a challenging 5 to 6 year period. Today, I'd say most operators, maybe some outliers, are doing prorates, but most are upfront. So that's the positive side, but know that there will be concessions in this market for at least 2 more years. Or 3.
I just came with the team, and I just came across a brand new deal that just started lease up West Valley. Won't mention where or what.
You said West Valley.
Well, it's a pretty large area, West Valley. Yeah. 2 months free plus $1,500 that you can use as you please, meaning the resident could choose to have that prorate extended throughout the lease. So.
Yeah. There are good things happening though. I'm underwriting a deal right now. It's in the location. I won't say the name or where it's at, but I mean it's built after 2010, and they're getting 7% positive trade outs on their 2 bedrooms, and on a weighted average between new lease and renewal, they're 3.5. So there are deals to be made. It's just that much more competitive, and the returns are just getting compressed because you're having these discretionary funds buy these deals that just have a lower cost of capital than most groups.
Right.
And by far, like I said, the close-end fund vehicles are the most active today. And I'm starting to see the JV market open up a little bit too.
I think the other factor that, this massive slowdown is partially, we don't talk about it anymore, but in 21, 22, 23, it was, there was a high percentage of 1031 capital exchanges, right?
Yep.
That was a lot of guys selling out of California, 70s vintage, trading out asset classes in terms of moving their portfolio from an average 75 to 2005 or 2015. So that momentum's gone because there's no transactions, so there's no 1031. So you also have high net worth individuals that, I wish it was us, maybe it's you. You have $50 million in the bank or $100 million in the bank, and you're collecting 4.75 in your money market. Well, am I going to go chase a 4 3/4 cap,
or just collect my money market account
at no risk, really? Yeah. So those are the challenges we have to get through.
Yeah, and you guys, going into this last section, you guys pretty much already answered some of these questions that I was going to pose to you.
Well, we are overachievers.
You guys are so good.
Mostly this guy.
So
yes.
good. I'm going to ask this to you first, okay? So we were talking about the difference between developing and acquiring, right? Replacement costs, et cetera. Do you see any potential operational risk between the two different investment platforms, like meaning acquiring a deal with one of our clients or starting ground up development? Is there any risk involved on the operational side?
I mean, obviously, from a development versus acquisition, I mean, there's way more risk with developing.
Right.
I think if you're an operator and you're just trying to get deals and you're not realistic with the market and you don't have a true pulse of what's happening and you don't have an understanding of what's to come based on historical data, I think there would be concerns around over-promising and under-delivering. So I might be hungry to get Mark's business and create an I see this all the time, unrealistic underwriting. Or Mark, let's say Mark's not good at what he does and he's chasing a deal and he's got to get to a number. So in his model, I mean, it's a model. You can tweak it, make your exit cap whatever you want in 10 years. And I think the management companies that choose to avoid that conversation and say, yeah, we'll get it done. We'll make it happen. I know you underwrote it. We're here to manage. We're going to make it happen. There is extreme pain ahead because in month 3, 6, 9, 12, whatever it is, you're going to say, you guys said you could do this. what's going on? And that's a challenging exercise because you want to do right by your client. You want to support them. You want to be realistic without being bearish. So there's got to be a counterbalance. Like say, here's our projected NOI or rent growth or lack thereof, and here's all the reasons why from a data perspective. We don't have a crystal ball, but really supporting the acquisition group or developer with realistic expectations driven by data.
So I'm going to ask you both for your crystal ball right now.
Don't have one.
You just stated that, but I'm going to put you on the spot as far as crystal ball. So from your view, okay, let's look out 2-3 years. Now we know supply right is going to pretty much drop off towards the beginning of 27, right? Do you see the landscape as far as the attraction for investors like yourselves to be a little bit more open to new developments, or will the acquisition of current deals still be just more of an appetite?
It's hard to say. I think so much of it is dependent on what interest rates do. We were just looking at doing a ground up development deal. And in this case, it had a really attractive capital stack. It was financed with tax exempt bonds. So we had a really good favorable interest rate, but the development period was still 3 years. And then we just ran a sensitivity that said, okay, well, what if it was market rate interest rate and you sign a non-recourse loan, your all interest rate is 8% plus, you're billing for 3 years. Not to mention hard costs are probably the biggest threat in that capital stack. And in this case, hard costs went up $5 million in over 4 months. So, hard costs plus your interest rates plus what our rent's going to do. I think there's just so much uncertainty that to have conviction around breaking ground today, assuming you can get it capitalized. And I try to follow the tariff announcements as much as I can, but it changes every week. It's tough. So, but I think buying existing is far less riskier. You can just reduce the amount of variables you have to consider when you're buying.
Yes.
And so again, we're not developers. That was a one-off basis. So we're going to keep buying. We're not going to try to time the market.
JC, how about you?
I don't really have an answer. There's no crystal ball. I mean, clearly, an acquisition versus development, less risk, more certainty. And I think the uncertainty day is kind of the ruling narrative, the pejorative narrative around we just don't know tariffs, rates. I'm really concerned about the 10-year just because of the amount of bonds we have to sell through the auctions. It's $8 trillion, I think, still this year, 7. And you're going to have to keep rates at a competitive edge to get people to buy those. And that's the problem with being this far in debt as a nation. So I don't know what's going to happen. I hope we get fiscally more responsible as a government, meaning U.S. specific, and really get our house in order from a financial perspective. Otherwise,
everything. Yeah.
So we have a lot of tailwind from being in the U.S., being in Phoenix Metro. I think there's a lot of benefits here. So I think what you've seen historically is when that uncertainty concern kind of leaves the environment or the conversations at the coffee shop, in the boardrooms, that when people say, okay, I want to go, Phoenix is on the top of the list, or
Totally.
at least top 5, right? So when that sentiment shifts, I think you'll have another wave of people saying, I really want to be in Phoenix, whether it's development or acquisition, depends on what your focus areas are. But I think the opportunity here long term is at a high level.
I just met a new group out of the Midwest, and they're vertically integrated. They're developer owners, owner managers, just like we are, right? I posed the same question: what's making you look into Phoenix for development? And of course, use third-party management, and they're just very bullish. They see Phoenix as still being a very, growth submarket within the country, considering, still. We talk about jobs. We track jobs so much. You mentioned that earlier. I mean, that's why I'm here, right? Different reasons, of course, but anyways, just wanted to add that at the end. So we'd love to close out, Mark, just a little bit of a feel-good kind of question, as far as what we're grateful for today.
Oh, sure.
Do you want to go first? You want to go first?
Yeah. Grateful for my wife. She's
Good answer.
been
She might watch
awesome. Yeah. No, my mom had to have open heart surgery about 8 months ago, and she's doing great now. But at the time, she was great. So grateful.
Good.
Grateful for her. Grateful for the whole family.
Fantastic. JC.
Relationships. Like, I love that Mark's
Man,
here.
they matter, don't they?
And I've known Rocco a long time, and I just think when you do right by people and you support someone on the other side being successful, I love Mark's growth. Smart guy. You were an intern here. Can I say that out loud?
Yeah, I was. I think
You
I was
mentioned that when we were walking over to the
18 years
studio.
old, 19 years old.
What year was that?
Oh gosh,
You're gonna make me do math right now, aren't you?
11 maybe.
It was a long time ago. Yeah.
Something like that. It was a long
Crazy.
time ago.
Crazy. No,
He
it wasn't that
remembered.
long.
He
Come on.
He remembered which office he was in too.
That's wild. So yeah, just to see your growth, and you're respected in this industry, and I love seeing people kind of move into where they feel like they're delivering, they're clicking. Like, I hope you don't have imposter syndrome, because you have a lot to offer. So sky's the limit for you. I'm glad you're here.
Appreciate that.
Yeah, relationships. What about you, buddy?
You know what? I'm going to refer to the man behind the camera over there. I'm going to say thank you to Mr. Brian. I give you a lot of heartache, and I hope I'm saying that, exaggerating, of course. I hope it's not too bad, but I just wanted to say thank you to Brian. So really appreciate you, buddy.
I think one of these days we have to get Brian to come around and get in the shot.
Do you know how many times?
But we got to set him up so he's ready.
Do you know how many times I refer to him when we're recording, and he just looks at me like, "Don't do it, don't do it." And you're right. We should just force him to come. You're his boss. Just tell him to come over.
No,
We'll
he's
get
got
it
to be
going.
ready. Yeah.
We'll get it going.
Yeah.
Mark Mandala, thank you again. Really, really appreciate
Thanks
the
for having
time.
me.
Thanks for flying out specifically just for this, not for any other work functions, of course. So really appreciate you being here.
Thank you both.
Multifamily Forward, presented by Mark Taylor Consulting. Thank you.